Hi, welcome to this week's episode of Jason Talks Tax.
Another year, another pile, numbers stacked up mile by mile. It's time to sit, reflect, and add. Doing taxes ain't so bad.
Okay, so today we're going to be talking about a cash out refi. When is this valuable? What is a cash out refi? Okay, and why is it attractive to real estate investors? So, as you know, if you sell a property and there's a gain, there could be capital gains tax associated with it. It could be short-term capital gains if you sell the property within 1 year. It could be a long-term capital gains if it's more than 12 months. But let alone, there's always going to be the capital gains tax, and there's also other things to consider like depreciation recapture and net investment income tax. One popular way to avoid all this is by doing a cash out refi. So for example, right, let's say you buy a property, $40,000, you put about $30,000 in rehab, and now the property is worth $120,000. Most of the time you're able to borrow about 70 to 75% of the ARV, which is after repair value, which means how much the property is worth after you fix it up. So if it's worth $720,000 and you do a cash out refi at 75% loan to value, so let's see, 120,000 times 75, you're able to pull out $90,000 of cash tax free. So imagine that. You bought a property for $40,000, you put in $30,000 of rehab, you're all in at $70,000. And then a lot of lenders have a seasoning period. A seasoning period is how long do you have to wait before you can do a cash out refi. A lot of lenders have a 6 months seasoning period. That's why it's very important to have that talk with your lender, find out what's their seasoning period before you commit to them. Okay? So imagine you're all in your property, $70,000, now it's worth $120,000. You pull out $90,000 tax free, right? Because to the IRS, that's a loan, that's not income. You have to pay back that $90,000 one day. So then therefore you're not taxed on that, which is great. Versus if let's say you sold that, let's say you put in $40,000 and you buy it for $40,000, you put in rehab for $30,000, and now it's worth $120,000. If you sell that property, now you have a capital gains of about $50,000, which is subject to a capital gains tax. And then if you ever took advantage of depreciation on that, now you got depreciation recapture to be worried about. So that's one tax strategy that you could avoid paying taxes right now. So that's why I'm a big fan of doing cash out refi. That's how I first got started in real estate, right? So when I first got into real estate, I saved up some money. I bought one property in Indianapolis, 4769 North Michener in Indianapolis, Indiana. Bought that property, fixed it up, did a cash out refinance, bought another property in Tabor Street, got a discount. I bought it for like $40,000. I put about $30,000 into it, and then did a cash out refinance again, got my money back, and then bought my third property. So that's one way that you can avoid paying taxes while you're growing your real estate portfolio at the same time, right? So this has been a strategy that's been around for decades, but recently in the 2020s, that strategy got coined BRRRR, which stands for Buy, Rehab, Rent, Refinance, Repeat. So you buy the property, you rehab it, you fix it up, you get the ARV up, you rent it out, you go to a lender, you refinance it after the seasoning period, you get your cash back, and then you go buy another property and do it all over again. So that's a great way to grow your portfolio if your cash is limited. Whenever you're doing that method, you should always make sure that you're not going over 70 to 75% of the ARV when it comes to purchase price, rehab, and closing costs, so that you could get back as much as your investment as possible. Because if you could cash out all of your money that you put into the property, now you're playing with house money and your return on investment is infinite, right? So that is a great strategy to use if you are a real estate investor. If you have any questions, feel free to reach out, and don't worry, your accountant handles that.